We are live, and I see that in this they have a countdown thing, and I don't want people to miss out on a countdown. So let's see what happens if I do this. Just kidding. I could only take 10 seconds of that. All right. So, this is the REI Rocks review. We go through different panels, roundtables, different types of discussions like that on the topic of commercial real estate and being in the business of it. Angel, do you want to say a little bit more about what we're up to?
Honestly, we're looking at all of the content that we've collected from the past 6 summits, and we're breaking it down so you get a better idea of what we're doing each and every summit, because we want you to be a part of it. We want you to join our family and be a part of what we're doing each and every summit. It's amazing. It's a lot of fun, and I think it would be of great benefit to you.
Awesome. Awesome. And Halloween's coming. Is there anything spooky about this particular one? I know that like I brought my chainsaw, of course. Which, like, what's a podcast without a chainsaw, right? That's what I could think anyway. But we're joined not for chainsaws and ridiculousness and enormous toy cockroaches and stuff like that. Andrew Rosenberg is joining us today. How are you doing today, Andrew? You got up bright and early just for us. Thank you very much for that.
Good morning, Dan. Aloha from Hawaii. I'm excited to be here with Angel and Jason and you, and I've never seen anybody with props like Dan.
I saw the look of shock on your face. I was like, "Oh, Dan's pushed it a little too far this time."
No, Dan has never even got close to too far yet.
Excellent. That's the spirit. Okay. That's probably a good call. All right, and we're going through the economics panel, and the thumbnail I put up especially for this. I thought it summed up the feeling by the end that everybody had. I like economics, I think, take on a slightly different light right now compared to, say, like a year and a half ago. Andrew, do you want to, what do you think the audience should know to prep them for this, other than that's going to be at 1.5 speed so that you learn how to consume content faster, just like the content that we have? But Andrew, what comes to mind?
I think, if there's any terms that a person doesn't know, they're pretty easily you can Google them. And then, of course, I would always just say, you can always DM Angel Williams or myself, and we'd be happy to break it down for you. The last thing I ever would want is to, when we get into the weeds, for it to be a distraction or a discouragement to a person.
Yep, I love it. All right, so we are going to start watching the video right here, and I need to remember to hit that because it's the smart thing to do. And then I go, there it is, and then we got infinity and beyond.
Infinite loop.
Move it back here, rock and roll. But it's awful quiet.
It's our fall summit, and this is going to be an amazing panel. I am super excited. We're basically going to talk about just economics. Andrew's going to moderate for us, and so I'm going to let you take over, and I'm going to stop talking.
All right.
We're going to do quick introductions for each of our panelists. We have Dominic Green, Chris Delizio.
We'll get this down at some point.
Yeah, hang on. I don't know why it isn't full screening anymore.
And I'm going to let start off with Dominic, and then go with Chris, George, and then Angel.
Because technology is awesome, except when it doesn't work.
That's pretty much it.
Chris, why don't you let us know a little more about yourself?
So I ran emerging market money early in my career. Switched to a tech fund at Pioneer Investments. Got a great offer from Fidelity, where I ran a growth fund for 11 years. Grew the fund from 20 million to 7 billion. Then I started to notice that things don't make sense anymore. I switched and ran a hedge fund called Focus Capital. Wrote a white paper called the $340 trillion problem, referring to the dollar system. But then I realized that nobody reads white papers. So I decided to make a fictional movie that's kind of like Good Will Hunting meets the Wolf of Wall Street, which shows that as interest rates fall, the premise is that as interest rates fall, asset prices rise. When interest rates go negative, all assets are worth infinite. That's what I refer to as the money game. So the movie's called Money Game, and it'll be out in early 23.
Thank you so much. George, why don't you give us a little brief introduction, buddy?
So I'm a real estate syndicator. I am also formerly an award-winning data scientist. My interest in economics stems from being a longtime investor and wanting to protect my principal.
Angel, all right, now it's on you.
All right, I am Angel Williams. I'm the face of our educational platform, the Academy Presents Real Estate Investing Rocks. We are syndicators. We have invested both passive and active side. We've been in residential for about 20 years and not leaving residential anytime soon. And I've got my BBA and my Master of Science in Economics from Baylor.
Wonderful. Thank you, everybody, for the brief introductions. We'll go right to the chase, the subject everybody's interested in, interest rates. And we're going to start off with Chris Delizio. We're going to go with how high can they go and how long before a pivot?
Sure. First of all, this is exactly the premise of my movie, that nothing makes sense. We all know that that the value of $1 paid annually is $1 divided by interest rate. So if interest rates are 10%, it's 1 divided by 10%, $10. As interest rates fall, say to 1%, all of a sudden the value is $100. No one's ever thought about what happens when interest rates go negative, like they are today in real terms, and they have been for a long time. And the answer we're going to show this in the movie. As interest rates go negative, all assets are worth infinite. The professor's going to turn to the student and say, my coffee is worth infinite, my desk's worth infinite, my chalkboard's worth infinite. Does that make sense? And of course, once the Fed plays the money game, nothing makes sense. And that's why you're seeing things like GameStop go to trading infinite. AMC go to infinite. There's actually a deli in New Jersey. I'll give everyone the business model just so you guys understand what they do. They make pastrami and they sell potato chips. It traded at $115 million, which I would refer to as infinite. But it's the same thing as Amazon, which over the last 4 quarters lost $45 billion and trades at $1.4 trillion. Right. So what we're seeing is the entire system is misallocating resources. And so that's the theme of my movie. Capitalism requires risk to allocate scarce resources. So now the system is broken, and you're seeing productivity just hit a 75-year low as the entire system starts to misallocate resources. So your question about the pivot. So interest rates are now at 2.5%, 3%. If interest rates go to 5%, you're going to see our budget deficit go from negative 6% to about 11%. But it doesn't include all the other things that'll cause problems. Like the last time in 2008, when we started hiking interest rates like this and we had a downturn, tax receipts fell 25%. So if tax receipts fall 25%, our budget deficit gets bigger. So I don't think that they can actually go much farther. They might be able to go another 50 basis points, but I believe at some point, if they continue on this path, there's going to be a sovereign debt crisis. So I think we're by November. I'm not even sure if it would happen in November. So I'm on the path that I think the Fed's going to have to pivot. They're going to have to pivot pretty soon.
All right. Angel, why don't you chime in? You seem pretty excited.
Yeah, so yes, I actually am. So this is kind of where I'm at too. So what we're hearing is that we're going to see 75 bips up in November and then another 50 in December. And I'm sitting kind of where Chris is too. I'm like, when are we going to understand that those things aren't making an actual difference? They're just continuing to pop up inflation. And that's why when I talk to people, I'm like, man, we are like right on the edge of stagflation, because the interest rates, it's not curbing the inflation the way it may have done in the past.
Mm-hmm.
The comments aged very well because, as you know, Amazon stock just took a big plunge recently. Bank of Japan, Bank of England all had sovereign debt crises in the making. And as we know, we don't know that we shipped $11 billion to Switzerland to go to 9 unidentified European banks. So this comment about pushing a sovereign debt crisis was rather correct.
That's really wild. Yeah, this is. I think it's just going to get more and more contentious too. I think this is fun stuff.
Well, I'm just thinking. I just keep in my mind just stagflation, because there's no other options. Inflation isn't stopping, but the economy is grinding to a halt. So when productivity is in the pooper and inflation is up in the rafters, we're going to stagflate because that's the only option. And the last real stagflation we had was like 81, 1980, 81. That was when the federal funds rate was like 20%. And that's insane. And so it's just like what's going on is not working the way it's supposed to work. So when Chris is saying things are broken, it's because they're not working the way they're supposed to work. I didn't know that the reserves at banks was zero, because that's also an infinite money creation. So if banks don't have to have any money in their reserves, then they can create tons and tons of infinite amounts of money, and then the dollar becomes worth nothing. So I don't know, it's all of these things happening in my head, and I'm just like, this is not going to end well. It's just not.
So one of the premises of my movie, when you remove risk from an ecosystem, you change the ecosystem. And so when we talk about things not working, everyone has to notice that 80% of the stock market is now passive and quant. There's nobody thinking left, right? Because so the ecosystem changed. I believe actually the ecosystem shifted from an investing system to a financing system. You're not investing in Tesla, you're financing them. And if I gave anyone on this panel $100 billion a year in stock options, you also, just like Tesla, could take 3% of the market share. Understand how much you're financing them. So I don't believe the system you're looking at. I believe the system you're looking at doesn't reward profit anymore. It rewards companies that need financing. like the deli in New Jersey, GameStop, which lost $800 million over the last 4 quarters and trades at $12 billion, and Amazon. None of us, we all know what the value of. Just ask yourself: would you be willing? How much would you pay for the right to lose $45 billion a year? And we all know what the answer is. It's zero, and that's Amazon, right? So why is it trading at $1.4 trillion? Does the system reward companies that make money, capitalism, or does it reward companies that need financing? And I think it's a system that rewards companies that need financing now. I think the ecosystem of capitalism has changed, and I don't think you're seeing capitalism anymore.
Hey, Dominic, what are your thoughts on how long before the Fed can pivot? It has to pivot. Sorry.
Well, I mean, I was looking at the Mortgage Broker Association chart, and they were kind of showing a prediction somewhere around Q4 of 2023. They think they're going to kind of keep interest rates where they're at now, kind of steady, and they think they might do one more raise, and then that's probably about it. They're going to hold it steady until quarter of 2023. But my thing is, and this just comes from when we're talking about in real estate, we know that now the home builders, if you saw the latest report from KB and Lennar, they're starting to cancel a lot of their land contracts, which means that they're reducing supply, which obviously means for people, when we're talking about multifamily, there's going to be more renters. So with that also being said, the rental rates have kind of slightly, when I was reading, slightly went down a little bit, but we're still above 15% annually as a rental rate cost for people that are renting apartments. So I think there's still going to be a steady, I think there's still going to be pain in the market because I don't foresee them pivoting sooner. I think they really want to hammer home that they really want to kind of get things in order as far as inflation.
Hey, George, why don't you chime in? We'll see what you have to say.
Sure, I'd say that all these predictions as to when the Fed will pivot tend to be very dispersed. You can look at the charts and try and interpret forward yield curves and such things, but I think what we really need to do is take a closer look at the parameters that are really impacting things here. For example, currently, I want to say around 12.2% of our federal budget goes to debt service, and but the interest rate on our debt is currently at multi-decade lows. If you look back even as far as 1988, the interest rate was around 8.8%, like 5 times what it is right now. In terms of what we're actually paying on the debt. So we know we can't do what we saw in the 1970s. We know that the economy is very weak, and I'll save my thoughts on that for later, but it's a very tenuous situation. I think they're going to have to reverse course a lot sooner than they wish, and the Federal Reserve Chief is just wanting to project this idea of strength, right? Because we don't want this sort of demand pull inflation where people anticipate inflation, and therefore we have more of it. But I think they're basically out of bullets.
Let me make one comment on regard to that. Notice that 6 months ago, the Fed told you, we will never run out of money, right? We will print endlessly. We will never run out of money. They've shifted from we will never run out of money to Russia cutting off oil, which sent the price of natural gas up 10 to 15x in Europe. Now they've shifted to we guarantee you that we're going to raise rates. So they've done an 180-degree turn, which means they've completely lost credibility. To me, it's kind of like pulling the goalie in hockey. It's your last option, right? You pull the goalie, you don't think it'll actually work, but you're going to give it a shot. So he lied to you that we're going to print the money like crazy. The other thing is, I think if they don't print, what makes a bond a risk-free asset? Everyone has to step back and say, what makes a bond free risk-free asset? And the answer is because they can always print money, right? But if they choose not to print, you'll see basic economics take hold, like crowding out, right? The government is as big as it's ever been. So if they just sit back and do nothing, you're going to see interest rates go to 14%. So the question is only, which by the way.
Okay, so we're all in agreement during this panel that they can't continue to raise rates. Yet we're sitting here, midterms are coming, we're in the midst of early voting, and now all of a sudden we're still seeing some possibilities that we're going to keep increasing. I'm just like, I can't wrap my head around when we realize that it's not working. Like, I don't understand why we keep doing this. What is it? It's insanity. When you do the same thing over and over again, but expect a different result. We keep raising the interest rate. It's going to bring inflation down. Oh, it didn't this time. Oh, it didn't this time. Well, let's try it again. Oh, it didn't this time. How many times are we going to keep trying it before we realize, hey, maybe this isn't working?
That's a fair question, Angel, but I can't speak for the Federal Reserve. I don't know what they do on their end, but this is a big if you actually believe what they say, which that's another issue. If you're going to just totally base it upon employment, by the data they have, employment is still really high. So by their model, at least publicly stated, they have every reason to just keep raising interest rates. And if that's the model, which I'm not saying it's a good model or necessarily I believe that that's their model, but that's their publicly stated model, then they should be able to keep raising rates for quite a bit before they absolutely break things. As discussed, we've already seen a lot of turbulence in capital markets around the world and debt markets. So the point of them breaking things could happen sooner than later.
Yeah, the one thing that I haven't brought up because I'm the least qualified around. I've just had a ton of like raw data input and for years and years, like watching really carefully. And the thing that's crossing my mind is, when do we stop assuming incompetence and inefficacy and start to go, well, maybe this is exactly like this is intentionality that's coming out right now. Like there's basically a play going on, because like all I see is around the world, these raised rates are pulling the rug out of a lot of other countries. And so like if that's the actual play, and then we're just getting the official label version of it, like I don't feel confident enough to start pointing the fingers in normal situations, but in a commentary of just bouncing ideas, that's what's going through my mind. So
that's a fair question, Dan. That's a fair question.
Let's keep going.
Way, then, as we know, with debt to GDP of 125%, it's a sovereign debt crisis. So to me, there's no option. I don't know what that number is going to be. I don't think it goes past 5%. Because just do the math on 5% and think about how much it's going to destroy the economy if interest rates go to 5%. So in our movie, we have one of the lines from the professor, he's talking about Germany, 1921, 1924, the Weimar Republic. And one of the quotes the professor is going to say is, print the money or trigger the revolution. Right now, they're triggering the revolution. They're triggering a sovereign debt crisis. And if you do the math, you'll see that there's no way out. So that I think we're basically we're in the ninth inning with one out. And it's just a matter of time that they're going to have to shift course and print the money or trigger the revolution. Right now, they're choosing to trigger the revolution. I actually think they made a mistake of not inflating away their debt to get to a point where they'd be about 70% or 80% debt to GDP. Then they actually could raise rates. Everyone has to understand, when Volcker raised rates in 1980 to was it 18%? Debt to GDP was 30%. Today, debt to GDP is 125%, and one of our biggest allies, which is Japan, has debt to GDP of 260%. So what you're seeing is the end of the dollar system, in my opinion, but we're right towards the end.
All right, this is going to transition us well into our next subject. Everyone's talking about a recession coming up, but we do have a nice segue into it. George, I'd like to, if you could explain to our audience, some people may know, some people may not know, explain yield curve inversion, its predictive qualities, and obviously, the way it's a nice segue into our next topic of, if there's a recession now, is it coming, how deep and how long? And it kind of ties into with Chris's thoughts. 53 nations have exceeded 130% GDP. 52 of the 53 have defaulted. And I would argue that they all have defaulted, because Japan's Nikkei is still negative from its 1989, 91 high. So 30 some years later, Japan's stock market has not recovered. To me, that is a default. But we'll let George chime in on yield curve inversion and then transition into the recession.
Okay, so first, what is yield curve inversion? When you see the rate on the 10-year lower than the yield on the 2, what that's telling you is that people are expecting that future rates will be lower. And what that means is they're expecting we're going to go into a recession and that we're going to have to see some cutting of rates. Now, what's its predictive power? It's been said jokingly that it's predicted something like 12 out of the last 7 recessions. So what happens is that, we haven't had a recession in decades without having a yield curve inversion, but we don't always have a recession every time the yield curve inverts. As for how long and how deep the recession may be, difficult to say with all this money printing. I've been hearing the everything bubble a lot. I can't think of a better metaphor myself. I don't know what isn't inflated. I like commercial real estate because I think it's possibly the safest place to be. But right now, I'm just looking at what is least overvalued. We could see bubbles popping all over the place. I don't have a great prediction as to how bad it will be. It could be fierce.
Hey, Dominic, why don't you chime in and give us your take on, are we in a recession? That's one fight we've had recently in economic.
Since the time of this panel, the 3-month and the 10-year have inverted, which is very unusual. Amongst capital market participants, that is causing a lot of trepidation. And if you think about it real simply, who would lend money to the government at essentially the same interest rate or lower? And you would say, here, take my money for 10 years or take my money for 3 years. It just it defies common sense. Clearly, the longer you were going to give somebody money, the more premium you would want to charge in terms of interest rates. So this video has aged very well, because just from the time we've done it, the world has got kookier.
No, and I
that is the technical term for it.
Yeah, it's going crazy. And I agree. I mean, why am I going to tie my money up for a longer period of time when that produces less of what I want? So even with real estate, the possibility of it being overpriced or inflated, it's still a super safe place to be. It's one of the reasons why we are not going to give up our residential, because it's a super safe store of value. Because as things are inflating, as things are going crazy, at least our money is sitting somewhere that's also going up and going crazy. So our money isn't losing value like it would be if it was just sitting in a bank somewhere.
Good point. Good point. And we passed the quarter after mark, and I want to let everybody know that you are watching the REI Rocks, the Real Estate Investing Rocks review. We go through our content, our library of content from our live summits, and we pause it to add our 2 cents on what's changed since then. And then that way we constantly have something that is poignant and timely. So if you want access to the rest of the library, especially because you now know the benefits of watching at 1.5 times speed, you can go to theacademypresents.com, and I'll put the link in the chat for that so you can check it out. But let's get back to the video.
Discussion circles. You know, is how imminently is one coming if you think it's not technically a recession, and how deep and how long?
Well, for me, I think, the data is one thing, but I think more so being on the ground and kind of seeing the activity of how people are actually reacting, right? They kind of give you a more detailed sign of what's happening. So what I've noticed is not as many people are spending as much. And this has just come from me to doing real estate, right? Being around in the commercial aspect of it. And so I was saying prior to this, I think we were already in a recession. It just didn't show that, in the data of how they classify what it actually is. How long will it be? I have no idea. I mean, I think nobody really knows. I think though, based on if the Fed is going to be as hawkish as they are, really trying to drive home, and this whole talk about them trying to have some type of soft landing, you know how the federal government is. I mean, they're going to either overshoot or undershoot. And so it could be one of those things where, with all the money in the system and everything that's going on, it may be longer than the last one we had.
All right. Okay, well, Angel, we're going to switch topics, but it's still related to the recession.
Which we are.
Well, yes. Okay. I'm glad we agree on one thing. It's amazing to me that the energy crisis in Europe isn't getting more press in America. I know it's across the Atlantic, but when the world's largest steel factory shuts down or BASF isn't producing chemicals, it is rather naive not to think it's going to have a global impact on the economy. And similarly, like Chris is talking, you have to pick your poison. If you don't want to continue the money printer, where's the collateral for the global economy to have credit so that the world can function? 40% or more of the world's liabilities are denominated in dollars. And if there isn't dollars in the system to be collateralized to extend loans, the whole system goes to a stop. It's GFC all over again, but even on a worse scale. But we'll focus on energy for the time being, Angel. We will get to the effect of the US dollar being unusually high, but why don't you chime in on energy costs?
So when supply is diminished, whether it's burning oil in the Middle East, because that's happened too, they just burn it, let's set it on fire, let's just get rid of it. Whether it's doing that or shutting off massive supply chains and shutting off any kind of supply. When supply decreases, and we're talking the curve. So when supply is decreasing, it's decreasing at all levels of quantity supplied. And that is going to cause the price to go up at all levels, because you wind up in a situation where the people that need it the most are going to figure out how to pay for it, which puts even more pressure on us in the US, because it's going to be global. It doesn't just happen in one location. And so like in the late 70s, when they were rationing fuel, there would be lines that were super, super long so people could get gas. Well, I don't think we're going to wind up in a rationing system. Instead, we're going to wind up in a system where it's $10 a gallon, $15 a gallon, $20 a gallon. And people will make changes in the long run in how they can transport, how things can be shipped. But in the short run, it's going to hurt. And it's going to hurt a lot. And just like what Dominique was saying, I mean, when the government gets involved, it's either too much or too little. And that's the way it always is. It's either too much or too little. And then you've got the Fed who can make changes quicker. But really, their only tool seems to be printing money, or they're either quantitative easing or they're putting it out there. There seems to only be one tool. And I think the other thing that you've got playing here too is, prior to credit cards, I think that it was easier for the Fed to actually control things, but it's much harder for them to actually affect massive changes because we've got all these credit cards and we've got credit card debt, and it's supposed to be delayed payment. But for some people, it is a form of income because they'll just default on it and then pay taxes on whatever the balance was because it becomes income. And so I think that we're just putting ourselves in a situation where we're just basically pricing ourselves to death with inflated dollars that become less and less valuable. And I don't know. I don't know how other people don't see it. That's the part that gets me, is like, I know my dollar's worth less. Because if you increase the money supply by 100% overnight, but there's still only certain, but the value of the dollars is still a certain, let me start over on that one. Okay, so if you bought $100 and the money supply, that's all of it, it's $100, and it's split amongst 100 pieces of currency, then each currency piece is worth $1. Well, if overnight that's doubled, and now you have 200 pieces of currency, that doesn't change the fact that that money supply is only worth $100. You're just splitting it up amongst 200 pieces of currency now instead of 100. So effectively, each piece is now worth 50 cents as opposed to $1. I understand that. I've told people that story. People get it. But then when you apply it to like what's really going on in the world, people don't get it. And people don't understand that they've already switched from normal goods to inferior goods. They've already started buying generic at the store when they used to buy name brand. But they don't understand that that's a change that they've made because it feels like a recession. It feels like these things are going on. And people feel it and they see it, but it's like it doesn't sink in the same way. And I don't get that part. That's the part I don't get.
Hey, George, why don't you chime in on either subject, either nominal confusion or what Europe's energy crisis is going to have as an impact on the global economy?
Well, sure. But first, I'd like to see if I can help us understand how we got into such a mess in the first place. Who's directing our policies? Who are these economists? Well, an economist is someone who takes between 4 and 21 months to declare that a recession is underway. In most cases, recession already over by the time the recession is declared. So I'm not surprised that a recession hasn't been declared yet.
Can you pause it right there?
Crazy
Let's go back on that.
And how things got so bungled up.
And Andrew's losing it over here because it's a simple fact. Like, when do they call a recession? Months and months and months after it's occurred. Half of the time when they finally declare it, it's over.
Mm-hmm.
Because they take so much time deliberating, or in this case, recreating the definition. But like, if you've been paying attention to what you're doing at the grocery store, or what you're doing in your purchases, you're already making decisions like you're in a recession. Because we are in a recession, and we have been. So,
I mean, a rather big indicator is how many big corporations constantly are in news headlines of cutting staff and reducing staff. I've not seen the headline, and not that I trust the media necessarily, they do such a wonderful job, but where are these headlines of huge hiring surges? The person who says to me, well, Andy, the restaurant has a sign on the window looking for a dishwasher. So the economy must be strong then. That's not exactly an accurate portrayal of a strong economy looking for dishwasher.
Right. I completely agree. And one thing economically that I maybe I'm incorrect, but I doubt that the audience in general really understands is when you're talking about bonds and yield curve inversions, I think the thing that's being skipped is who buys the bonds and why do they do it. And I don't know if the Fed's policy has changed. I should know this, but back in 2020, they removed the reserve requirement. And bonds are one of the few things that can be used as a reserve. So corporations, what they'll do is they'll use it as collateral on their loans. And so that way they've got some income coming on, in other words, interest on that collateral. So they get kind of like the double dip there with that trick. And that's why people end up buying these bonds. And that's why it does actually make sense that in some situations people would pay more for a 2-year than a 10-year, because they know that there's basically a hot potato play when it comes to bonds or triple net lease real estate. I don't know if there's anything to add or if you just want to continue.
Yeah, I mean, for anybody who wants to go down that rabbit hole, not that I say that they have to, the two best sources that I would argue would be George Gammon on YouTube, and then even better because his source is Eurodollar University, and they're going to talk about the repo market. And when I mean repo market, I'm not talking about big sweaty guys showing butt crack at Holloway cars. I'm talking about the repurchase market. That's the overnight lending market, which is a staggeringly huge market. And within that market, that's where the collateral comes to play. So if I want to borrow money from the bank of Dan, and I say, hey, I'm Lehman Brothers. Dan, it's 2007 or 8. I want to borrow a whole bunch of money. And you're going to say, I'll pay you back tomorrow, Dan. You're going to say, what do you got as collateral? And if I tell you, well, I got mortgage-backed securities, you're like, ooh, Andy, what else you got? Well, I got some treasuries. You're excited now. So that I won't get into it too far, but that's the rabbit hole of, collateral and repo and all these things. Where it gets dicey is a thing called bond rehypothecation. So this is the kind of controversial areas. I go to Angel and I say, "Hey, Angel, I want to borrow money." And you say, "What do you got?" And I say, "I got treasuries." Okay. Then I go to Dan. I say, "Hey, Dan, I want to borrow money." I got treasuries. Hey, Chris, I want to borrow money. I got treasuries. The only problem is I've used the same bond 3 times now. Nobody really knows exactly how many times we rehypothecate the same bond. So we think in terms of linear effects. I'm a simple person. I do math. 1 + 1, equals 2. And that's really not the way it works within financial markets. I mean, we're using derivatives. We're recycling collaterals. It's a little more complicated. It's guys like Gammon and Jeff Snyder from Eurodollar University. They do an excellent job of explaining these concepts. If anyone wanted to go further down that rabbit hole, not that you have to.
Well, I didn't realize that you could spin the same bond out over and over again.
Oh yeah, it's a thing.
That's
Fantastic. Yeah,
So
it sounds like
I mean,
first position, second position leans on
Well, it's almost
real
like
estate. But
there's a velocity to it where like the same dollar can flip through the economy multiple times. So now we're saying the same bond can flip through the economy several times. And that's just, wow.
Yeah, and I guess we won't go too far off the tangent, but when Dan's talking about buyers of bonds, yes, not everybody has the same logic. Investors' logic and like a sovereign nation's logic can be very different, or a corporation or people doing a hedge. There are different logics. But the simple truth is the biggest buyers of bonds typically used to be Japan, China, Germany. Those countries are not buying the same amount of bonds. Specifically, the Japanese are having to sell their treasuries because they're trying to intervene in their falling currency. China has obviously a vested interest in not wanting to have too many bonds. We won't go into the whole Taiwan thing. I don't want to get Dan triggered, but clearly they don't want to get sanctioned. And if you're worried about sanctions, you can't exactly have a huge bond holding. Germany, they've got their own problems now with the energy crisis that they're in. Also, the euro's obviously plummeting as well. So when we're looking at who's going to buy the bonds, it has to be the Fed. But then a guy like Chris is going to go, "Wait, Andy, you said no more QE. The Fed said they're not going to print money. Where are you going to buy these bonds from? If the Fed's buying it, they got to monetize the bonds. That means they got to hit their keystroke and print more money to buy those bonds." The other point that people are forgetting that is in the press but it's not getting any coverage is Janet Yellen, the Treasury Secretary, has essentially admitted publicly that she wants to start her own second central bank. The Treasury has already said to promote liquidity in bond markets, why shouldn't the Treasury buy back bonds? And bold-faced reporters asked her, "Wait, isn't that QE? I thought we weren't doing QE." And she said, "Oh, no. We're providing liquidity. It would be the Treasury buying bonds." And of course, the reporter went back and said, the definition of
Fed, it's like
QE
an infinite loop, right?
Yeah, the definition of QE would be a government or quasi-government agency printing money that they don't have to buy bonds, which would inject liquidity into a system. And she said again the same answer. No, this isn't QE. I mean, rather amusing. Now, you can make the argument that, unfortunately, like what Chris is saying, there's a global dollar shortage. That's why the US dollar is in relative terms to other currencies so strong, yet also so worthless in relative terms to what your goods and services buys you in the United States. So when Chris is talking about pick your poison, do you want a global recession, or do you want to print money? These are your two choices. So it's like pick your poison. It's actually coming further and further to light as government agencies are having to very specifically admit to what they're doing. The Bank of England, pension funds ran to the Bank of England and said, "We're going to go bust. We have all these derivatives that are linked to bonds. if you do not start buying bonds to get these rates down a little bit, we're going under. This is a systemic shock to the system. The Bank of England intervenes and calls it temporary. You know, again, the Federal Reserve, we sent over $11 billion to Switzerland to finance, we don't know who, 9 European banks. You know, if you've been reading the press, Credit Suisse in Switzerland, Deutsche Bank, UBS in Switzerland, several European banks, there's fear that they're going to collapse. There's a global dollar shortage. They don't have the dollars for the system to work. So when, you know, it's, if you don't have to get so into the weeds with these things, but I mean, it's very clear the world runs on dollars, whether or not you want to believe that or not still, whether or not that's going to change, which, you know, Vladimir Putin has his own intentions, and we can get into that some other time. But as of right now, the world runs on dollars. And if there's not enough dollars to run the system, you're looking at an entire systemic shock all over the world. And last I checked, that was called the GFC. So what has really changed since 2008?
People got more secure and thinking that it wouldn't happen again.
I mean, all it really took was a supply chain shock from COVID and an energy crisis. I mean, you could say that these are, you know, historical outliers, but in the 1970s was an energy shock, correct?
Mm-hmm.
You know, I mean, it would be rather naive not to think we didn't know the consequences of shutting down the world and thinking that the light switch would just magically turn back on.
Yeah, no.
Sorry, I don't want to go too long on a tangent. We'll run out of time.
No. This is absolutely amazing. And I really appreciate the fact that you're willing to go that deep into it. As a matter of fact, that's one of the things that I wanted to do online in general, is I thought that there were too many people pandering to, you know, lower intelligence levels of explanations and details and all that kind of stuff. So this is really, really exciting. And one of the best places that you can join in conversations like that is on Marvelous Mondays at noon Eastern every single week. You can get there from theacademypresents.com/meetup link. I'll put it in the chat momentarily. Angel, do you have anything else to throw in before we continue?
No. I have lots of things to say, but we'll just keep letting it go.
It's so intense.
In
Wow.
the first place. We really need to understand anthropogenic global warming. And for that, I don't mean that you need to have a degree in statistical modeling. We need to understand psychology. And we've seen a temperature anomaly of 0.14 degrees per decade since 1880, right? So if you live another 7 decades, you should expect to see a 1 degree increase in temperature, okay? Since 1960, 0.3. So even if you live another generation, 1 degree. And we've got, you know, over 1 billion people in India who won't be held back economically. They deserve progress, morally speaking, and they will burn fossil fuels to get there, just like we did. And I think we need to understand that there's a moral issue here. Energy is a moral issue. We need it to run our economy, and without it, we don't have money to face Russian aggression or whatever else we need to do. And by the way, I just point out, I'm not sure if you're all aware of this or not, but India is a lot hotter than the United States. If not worried about 1 degree, I don't think we should be either. But again, yes, it is a moral issue. And if you look at the Californian diaspora, a lot of that is being driven by concerns about anthropogenic global warming. Recently, they said there's not going to be any more internal combustion engines by 2030. You know, seriously, or 2050, whatever. You know, it's driving people out, and it really is impacting. I'd like to tie it back to real estate. This is a real estate forum. Why do you think there's so much migration to the Southeast? It's because all these high regulation states that are worrying about things that we're not going to live to see, and you know, tiny changes that are certainly going to make Alaska a whole lot more productive. Would make Michigan, my home state, a whole lot more productive in terms of agriculture. And it's really driving people out. So yes, I do think that it's not only an economic issue, but it's definitely a real estate issue. We need some more sane policies.
All right, Dominique, why don't we make a transition to the related subject that everyone's mind is the stock market. Obviously, Chris is the resident expert on the subject, but we'll let you chime in on that as well. We all know that as the market goes down, there is an economic effect. You know, when you're looking at your 401k and you're thinking about retiring, it goes down 20%, you're not retiring. If you're looking at buying a new car, a new house, that luxury boat, I won't go too far into it, but it's rather obvious that we've used our homes and our 401k accounts to finance our lifestyles in America. What is the effect of the stock market going down, and I don't see it going up anytime soon necessarily, going to have on the global economy and in real estate?
Well, I think there's two sides of it, right? For those that were leveraging the stock market to do other things, to buy whatever type of goods and services or invest in other things, with the values going down so rapidly, especially because, you know, most of the stock market was just allocated towards the tech, right? So those are the stocks that got hammered the most. So you lost, what, 20, 30% of their valuations. from the highs, they're going to start pulling back, which is going to probably make it for some people that are raising capital for certain type of investments harder to raise money to actually invest in those projects, which means now you're going to have probably more of a what's the word I'm looking for? You're going to have more of a lag or supply of opportunities, but in that same essence, the value, because nobody's not as many people going after those particular projects, those values are going to start getting discounted. So, but on the other side of that, from people who are been waiting for opportunity to invest because asset prices were so high, and if they have cash and available cash, this is going to be the opportunity to get in. Because as I say, you make your money when the market is at its lowest as opposed to at its highest.
Angel,
Chris,
yeah,
why don't you just chime in just briefly?
I wouldn't mind talking a little bit about energy, just because I think that's.
I mean, I'll let Angel chime in on this because it's more her jurisdiction than mine. But as an LP, I see quite a bit of GP deal flow, and all of a sudden I have people begging for money harder than they have in recent times, going as far as offering GP shares to LPs because they're desperate for money. And as we all know, our good friend Ethan Gao is quite strongly promoting as, hey, if you're short, come see me. It's going to be expensive, but you need me. I'll let Angel chime in on that, but this has aged very well because the situation is worse now than when we recorded this video.
And we didn't record it that long ago. But no, it's definitely different. We are, we're in a contract in a property, and we're in a situation where it's a bigger capital raise. We were fortunate enough to get a really good loan, but not everyone is there. Not everybody's getting the same kind of terms we got. And I'm already asking, and I'm already talking to people like, hey, you reached out to me a few months ago, said you might have some capital to place. And I usually don't do that. I say usually. I didn't do that last time. I wanted to make sure that I had the deal, that we were good, we were under contract, we were moving forward. I tried to make it a lot more by the book last time. Whereas I feel this time around, I'm preparing for it to be harder, because I think that there are a lot of people that are in the same spot where I am, where I don't want to have a bunch of dollars in the bank, because dollars in the bank are losing money. And so that makes it a little more difficult to get liquid, because most of your dollars are tied up into assets that aren't easily liquefied, right? So we're in a weird spot. And I think that it is going to be like what you were saying, Andrew. People are being a little bit more aggressive. I think people are expanding their lists. So they're expanding their list size. If they talk to 150 people, usually on a capital raise, now they could be talking to 300, 400, even 500 to try and raise the same amount of capital. So that's my experience sitting on the side, just listening to my friends and then getting ready for our own next deal. So
thanks, Angel. Thanks, Dan. I just wanted to make sure we had that real estate tie-in.
I was actually thinking the same thing. I was like, somebody better stop.
That's so funny. Yeah, that's the thing though, is I think one thing that it keeps on coming up is people who are having trouble actually closing though. And I think that's going to be the difference. It's like, if you've actually got the network and people like behind it to make it happen, I think I think so many people are having trouble that there's room for people who, basically check all the boxes on their deal. So
one of the biggest things right now. Russia never would have invaded Ukraine if they didn't realize that they could cut off. First of all, they needed the backing of China. So they definitely have the backing of China. But they also realized if they cut off energy and natural gas to Europe, energy is the master natural resource in the world, right? So if they cut off energy, they knew that Europe couldn't survive without Russian energy, because I believe Russia is the biggest exporter of energy in the world. Right, so if they cut them off, prices would have to go up. But you talked about the steel mills closing. So if you cut off energy and steel mills close, then the price of steel has to go up, right? To offset the cost. So once this inflation thing starts hitting, and this is why the Fed wants to stop it as quickly as they possibly can. They never expected Russia to cut off all of natural gas. So that's why they did this reverse pivot from we're never going to run out of money 6 months ago to we're going to raise interest rates like crazy. The problem is they completely lost credibility. So and now the inflation thing is out of the bag. So now you're going to have to see steel prices go up and chemical prices go up as steel mills close. So when people talk about, are we in a recession? Yes. I don't care about what their definition is. We are in a recession, and it's only going to get worse. And by the way, it's going to get harder and harder. This is going to be a very difficult winter for Europe. because they're not even sure if they're going to have the supplies. So they're going to have to burn coal and wood and all these things to heat themselves during the winter. So that's point number one. The other thing is, I believe the stock market is completely broken. I don't think that the market predicts anything anymore. I mean, just back up and think about what the stock market is. 80% of the stock market is now passive and quant. It's not people anymore, right? The stock market doesn't predict things. It reacts to Fed policy. The Fed raised rates, stocks go down. It didn't predict it, right? We saw what just happened. They raised rates by 75 basis points, and then it went down. It didn't predict it. So this whole belief, I believe this whole belief of that the markets are efficient. The professor in my movie is going to lift the book, The Efficient Market Thesis. He's going to laugh. He's going to say smart people thought the world was flat once too. Because we're all watching. I mean, the irony here is that I saw a clip from Pete Davidson and Kate McKinnon from SNL, and they're talking about how the stock market's broken. But financial professionals are still telling you that markets are efficient. But we're all seeing that markets aren't efficient, don't make sense. So that's one point. The other thing is, notice that oil companies and natural gas rig companies, I can actually buy oil companies as low as 30 cents a barrel today. There's a company it's a UK-based company that's actually has a huge Alaska oil, trades at 30 cents a barrel. It's called Pantheon Resources. Petrobras in Brazil trades at 2 times trailing free cash flow with a 50% dividend yield. So is the stock market incentivizing us to produce more oil, or is it incentivizing those companies to buy back their shares? If I'm those companies, I'm buying back my shares, which actually causes a bigger problem because we're going to have even a bigger lack of supply because nobody will invest in it. They'll just buy back their shares. And honestly, I would tell the management teams, buy back your shares, wait for the oil price to go back up, and then sell your oil, but leave the oil in the ground right now. So I would argue that our system no longer incentivizes profit. It incentivizes, again, it's a financing system. But anyway, sorry.
No, that's great. One of your points of Russia being the largest exporter, that might be the case by actual numbers, but it's not the case by what should be. If you think about it, both North America is doing a disservice to Western Europe by not doing their job. There's lots of oil and gas in America. We all know that we were an energy exporter. No longer. I was going to try to keep this politically neutral, but talking with Amy in the chat, she says, "Oh, screw it, just go and tell the truth." Canada, same thing. You have Justin Trudeau stopping terminaling, stopping storage, stopping companies at every turn in the name of green. Which I like fresh air and clean water. Don't worry about that. But we all know that there's a lot of oil and gas in the world. This idea that there's the scarcity is a complete farce. It's a manufacturing scarcity. I mean, look at Venezuela. If we wanted to, there's quite a bit of oil under the ground there. They ran it down into the ground. They don't know how to get it out, but it's there. So this idea that there's a lack of energy in the world is absurd. Now, whether we want to use it or not, that's fine. We can, people can have that discussion. Same thing with nuclear. As you'll notice, Japan's restarting their nuclear reactors. So George, why don't you chime in? I saw your eyeballs kind of going off while Chris was talking. It sounds like you wanted to add in something.
I couldn't help it. I mean, Amy Silvis is just so entertaining. And if you read the chat, she's got some fabulous comments about how we should just let it fly. But you don't have to take the blame for, blowing the non-political thing. I think I already blew that for you, Andrew.
Okay, well, I'll blame you then. So I don't have to get dinged as the moderator.
All right. So, we might be in early days as far as, I'm going to focus on commercial real estate, if you don't mind. When they see things leveling off a bit, retrading is becoming common. A lot of it's rate driven. I would say just wait for bridge loans to come due. And we're going to see a lot of people who just can't make a go of it, and prices are going to have to come down. Now, I say come down, but what prices are we even talking about? Are we talking about nominal prices, inflation adjusted prices? How big is inflation actually? There's a lot to go on there. But also just a quick throwaway here, Chris. You mentioned the efficient market. I wouldn't be up by nearly 100% over the markets over the last 5 to 6 years if the market was efficient. So I'd be one of those people tearing that book to pieces as well. But absolutely, I think that we're early days.
Well, okay, Angel, why don't you go next? I see there's some discussion in the background, so why don't you chime in on that?
Well, the whole idea of going green it's hilarious to me, honestly, because who's going to go green? The developed countries. And that's going to make our products, goods and services more expensive in the world market. And so the less developed countries, where most of the manufacturing happens anyway, are just going to keep going with their oil and keep going with their petro. And the pollution is going to go crazy because they're going to be producing like crazy because their goods are going to be so much less expensive than everything the developed countries are putting out there. And the people in the developed countries want to buy things. So we're going to wind up with like this flip flop, and it's going to be, it's just going to be bad, but other countries can't even entertain the idea of going green. So the thought that it's actually going to happen is just hilarious, because I don't think, number one, that there's the demand that people think there is for going green. And number two, I don't think that it's cost prohibitive. There's just an inability to make it happen.
So during a sovereign debt crisis, I would argue we're in a sovereign debt crisis with debt ratio.
Yeah, I figured you were about to pause it. And so I go through this all the time with people. They're like, of course we're going green. And I actually had a friend message me and say, the infrastructure wasn't there when cars were created. When cars were built, there weren't gas stations everywhere. And so, because I told this person, I'm like, okay, so let's go electric. Let's have electric cars. There's not even electric stations everywhere. And his argument was, well, there weren't gas stations everywhere either. But I don't think that I should have stated it differently because it wasn't so much that there's not electrical charging stations everywhere. It's that electrical charging stations, the way the electricity is created is not green. And so we've got these electric cars that are supposed to be green, but they're not green because they use electricity that is not green. So they're, I don't know.
How far the rabbit hole do you want to go down, Angel? Because a Tesla is going to use about 5 times as much copper as a Chevy of an internal combustion engine. So if mining is evil and you don't like me digging a huge hole in the ground and ruining the environment to dig up copper, how do you want me to build these Teslas? These Teslas that are built in China, I have to ship halfway around the world to you. That's going to take some form of energy. Those tires that are made of rubber, last I checked, that's still a petroleum product. I mean, it's very tongue-in-cheek to say, oh, well, it didn't emit pollution, so we're all good. But the pollution had to be emitted in China to make it. The copper had to be mined in, let's say, Africa or South America. So all you've done is exported hypocrisy and exported pollution. Oh, we have clean air over here. We're good. And don't get me wrong. I'm not anti-EV or anti-environment. I'm just saying it's not an either or. You got to look at the full picture, the cost-benefit analysis. And like Dan's going to point out, which he has much more of a scientific background by far than I, we also, you have to take in consideration power generation loss from the time you generate the power till it gets to the consumer along those lines, and the limitations of battery technology. And then we also have to ask you the question is, what are you planning on doing with that battery that's full of toxic chemicals when the battery is no longer done? If we don't like nuclear energy because we have to deal with radioactive waste. That's great. But we're going to pretend that we can just magically float these batteries to environmental heaven on little unicorns that they're powered by farts that come out with rainbow sparkles.
Plausible.
Not politically offensive or anything. I mean, I'm just saying, like, if you're an environmentalist, great, but don't lie, don't sugarcoat the issue. Tell people the true cost and benefit analysis, and convince people. That's what free markets do. Free markets are based upon incentives and people making choices based upon being convinced. Governments coerce people, and totalitarian governments absolutely coerce people. And without getting on too much of a political rant, I mean, it's very clear which direction our country is going. Our so-called free market capitalist country, as Chris would argue, he's just talking in terms of the stock market, but I would argue in many aspects, not just financing. You're going to tell me this is a representative democracy that believes in free market capitalism? I'm not buying it. Now, whether that's a good thing or not, that's, we won't get into that.
Understood.
And our favorite punching bag when it comes to Canada in particular, it kind of has to be brought up. I won't bother saying the name. Maybe it's because I live in the capital, but the thing that really bugs me is, Canada's got roughly 35 million people, so it's more than Texas, but our GDP is less than Texas. And I just think that, like, the spin is outrageous because just the basic arithmetic. You've got countries with over 1 billion people in them. And, oh, well, we're rich and smart and well educated or something. And that's why our contribution will make a difference to climate change. It's like, I understand that, people need to do their part or whatever, but it's just like, putting the government in charge of it's just appalling. It's I don't know. I don't even know where I'm going. I just wanted to say something about it instead of staying quiet. But let's keep going. We got to get through this.
Where we are. And what we're trying to do is we're trying to use high cost energy during a sovereign debt crisis, right? So high cost energy being nuclear or windmills or all these things. What you should do during a sovereign debt is go for low cost energy, natural gas, which, like Andrew says, there's tons of natural gas out there. We just have to go get it. But we're trying to skip. And why are we doing that? Because I think the G7, I mean, the US and Canada clearly has plenty of energy, but the other parts of the G7 don't. like Japan doesn't, Europe clearly doesn't. Europe just outsourced all of their energy security to Russia. Imagine if we had done something so crazy as to outsource all of our manufacturing to, say, China or something like that. So that's what we've all done. We've actually outsourced our energy security and our production to companies that are not friendly to us. It's one of the craziest times I've ever seen. We also talked, I think, about how much money there is in reserves, right? There's actually so the U.S. is the global reserve currency of the world. And as the global reserve currency, you have what's called Triffin's paradox. So what you do is you run huge budget deficits every single year, which the U.S. has done for years. On the other side, you balance that off by exporting dollars, right? Your capital account. So your current account and your capital account have to balance, because the governor that controls imbalances in economies is currency. And if those don't balance, then your currency falls. I think it's really important to note that the world, the U.S. has $7.5 trillion or I should say foreign governments have $7.5 trillion of US dollar reserves. You saw this week, Japan, for the first time in 27 years, is selling dollars to buy yen. Just understand that $7.5 trillion, if all of a sudden they start shifting and that $7 trillion starts buying yen or their local currencies and selling dollars, then your current account and your capital account no longer balance, because you have a negative current account and you have a negative capital account, and all of a sudden the thing that would adjust would be the currency. But it was actually really significant that happened this week. So of the $7.5 trillion, Japan is the biggest, that owns more of our treasures than anyone. They want.
I just want to pause for one other thing too, which is that one thing about like trading in general is that whatever the small group of people who are actually transacting are up to, it actually does dictate the price of things for everybody. Very similar to in commercial real estate, you always get your comps, right? And, if you get some comp that's way off in outer space, it's going to bring everybody up, because they're going to say, hey, well, but over there, they're charging this much in rent. And I think that that's not something that everybody's really like mentally aware of. Any comments? Am I full of it? What do you think?
No, that's a good point, Dan. In talking to traders, the nickname for the yen US dollar trade has been called the Widowmaker trade, because it's a tough trade, because you don't trust the Bank of Japan. They've been so interventionist for the last 30 years. And a lot of what they do defies common sense and logic. I mean, this is not a knock against Japan, but a lot of what they do just doesn't make sense. And the rigidity of which they've proceeded along a course that doesn't seem to make logical sense scares the heck out of traders. You're thinking, how long can they play this crazy game? Well, the game's been played for 30 years. They've now re-intervened in currency markets. The yen was trading at roughly, let's call it 110 yen to the dollar not that long ago. And it would trade within a normal range of band. All of a sudden, it shot up as high as, I want to say, 150, 149 yen to the dollar. Guys like me, but more specifically my friends that do trade, I just look, we're really getting excited. Okay, maybe now is the time to short the yen. And a lot of them said, no, we're not doing it because we've been fooled for 30 years. And sure enough, Japan is intervening heavily in the yen to stop its plummet in value. And where they're getting that money to finance it from is dumping treasuries. So it's all interconnected, as you're implying, Dan.
But it like that sounded like, I don't know if you misspoke or if it was the inverse there, because the thing is, if the yen is like super duper low, then you should be going long, because it's going to gain some of that value back. So but you are thinking that because it's low, you want to short further, just for
it just depends on how I'm no professional trader, but there are people that believe that the game will break at some point, that they can only intervene so long, and that when they run out of reserves that they're able and willing to sell, that there's only so far they can stop. It's like the little boy in Holland putting his finger in the holes in the dam. There's a school of thought that's going to say, okay, I'll ride you out, and when the yen plummets, I'm going to make money. And then there's others that are going to say, okay, well, I guess I'll go long, because now they're intervening and the trend is my friend, and the trend is, the yen stabilizing back down. But I mean, just the idea that there is not a free market, that governments are intervening, and then it has trickle down effects all throughout a system, and we're left holding the bag to figure out what the heck is going on. that's not really ideal. You know, for me, we have every vested interest in the yen being strong. You know, I live in Hawaii. Our second biggest economy is Japanese tourists. So, you know, by all means, I'm excited about the Bank of Japan intervening in the yen. They can intervene all they want, but
Right.
it's not necessarily a good thing. You know, for real estate investors, it's not a huge portion, and it's different portions of real estate. But, you know, foreign buyers, that's a big deal that are going to come to the United States. And, you know, counterintuitively, when the dollar is strong, that's when people come in, which I know that you're going to say that, Andy, that makes no sense. People should be buying U.S. real estate when the dollar's cheap. They can buy more of it. But if you're looking at trend and you're thinking, well, how much more is my local currency going to devalue? Or how much do I not trust my government because of civil unrest coming up? Because if the world goes into a global recession and my little country now is just going to go up in flames, I want to take my money and I'll run to the United States and, okay, great, I'm going to get 80 cents on the dollar. So let's just say what I got, 6 months ago. It's still considered a relatively safe functioning jurisdiction. So for real estate investors, they're not going to come buy single family houses in Kansas City. Okay. But they're going to buy industrial properties. They're going to buy office towers in Manhattan. They're going to buy hotels. So it's an interesting issue for real estate investors to be considering that. It's kind of counterintuitive, but more foreign money will actually flow in because of a sovereign debt crisis.
Well, they need a good store of value, right?
Yeah, it's exactly. I'd rather be able to buy less than I could 6 months ago, but I actually have something, because for all I know, my local currency might be worthless, a year from now. And, maybe I need to get out. I mean, maybe I'm going to have to flee my country. I mean, these are, we take our lives in America very for granted. I mean, there's a lot more instability and uncertainty in much of the world. And if you're a billionaire, let's just say in Africa or Asia or Latin America, or even Canada, a foreign country, a crazy foreign country. I'm just teasing you, Dan. You might be thinking, hey, I got to get my wealth out. And even a haircut on that wealth is better than nothing at all.
Yeah, sure. Diversification, because the other play that comes to my mind is if everything's all about commodities, an Australia play would be pretty good, because they're at like $1.56 per US dollar, and that's pretty far out there in the range. But the last 10 years it has been like not great for them, but that is one of the places that China is definitely getting a lot of its materials from. So as far as like investing in the band, just as like a diversification play, it might not be the worst thing out there. So Angel, I don't know if you have time to finish the rest of the video here, but we did end up getting past the Q2 mark, where we like to point out that Jason Williams can help with your commercial real estate underwriting. And we have a link for that I'm going to put in the chat. Is there anything else you want to say, or what's your schedule look like there, Angel? And
I'm fine. I can continue. Andrew has
I'm good.
Do you? Okay.
No, I canceled all my appointments to accommodate you guys, and people were very kind to when I apologized and said, please, something came up. I please, can we reschedule? They were very gracious.
Exactly. We're here for all the people in the internet in the thing there. Yeah.
Let's keep going. 1.3. And for the first time this week, they started selling. So
it's the first time in 28 years, correct?
Correct. The biggest buyers have been, Japan, China, and actually the Fed. Those are the three biggest. So if Japan isn't buying, then you're relying on China and the Fed, which gets back to my point. They're going to have to pivot at some point, because the only buyer that's going to be left is the US Fed.
They have been one of the largest buyers for a while, Chris. Right. Yeah, we'll go backwards in time a little bit. 35 years ago to the date, on Thursday, was the Plaza Accord. So for a lot of us, we're just little kids or teenagers, or maybe early 20s for some people, but that was a long time ago. But that was when Germany, Japan, and America, and I'm going to use the word conspired, to artificially change the spread between the currencies. We've all discussed price fixing. If any of us fixed the price of a currency, we would go to jail. Right? But when governments do it, it's okay. And then sure enough, one day after, where Chris and I are discussing the Plaza Accord on LinkedIn, the very next day, Kuroda did what he said he would do, who's the head of the Bank of Japan, and they intervened in the yen. The yen had gotten up to 148 yen to the dollar, and in one day it went back down to 142 because they were selling dollars. So yes, this is a good segue into our next discussion: is how high can the dollar go, and how long before we go to a reversion to the mean. I'm interested in who'd like to go on that subject. Instead of calling out people, I'll just let whoever wants to take it.
I'm going to give that one a shot. So how, because it's related to what I was just talking about. So it's kind of like, so the first reaction you're going to see is the dollar strengthen. But what happens if those $7.5 trillion start selling? Right? So that you're going to get a massive reversal. It's kind of like being at a beach and seeing all the water get sucked out onto the beach and running out saying, hey, let's go play in the sand, not realizing that a tsunami's coming. So what this just happened was you just triggered that $7.5 trillion to say, wait a second, should we be supporting the yen? If they all start supporting their own currencies, then is the dollar really a risk-free asset? Are bonds really a risk-free asset? During a sovereign debt crisis, here's a question I would have everyone ask. Would you buy a bond with a negative yield from a country that's monetizing its debt? And so I think those $7.5 trillion are going to say, they're going to look for something else. They're going to look to buy some other commodity, real asset, could be gold, could be silver, could be doing it in their own currency, could just buy their own currencies. But you could have a massive shift. I think, honestly, the reason I did the movie is that what I believe is that we're timestamping the biggest currency transition in history. So when people say, well, when do you think it'll happen? I think my movie's going to timestamp it, which is probably May of next year. Because I think you're going to have once the Fed reverses course, and proves that they don't have the fortitude or ability, the financing to actually raise rates any further, then it could be the end of the dollar system. If it is, then you're going to see the dollar, that 7.5, you're going to see that $7.5 trillion return to the US, and you're going to have too many dollars chasing too few goods, and all of a sudden you have a currency, a shift in the dollar.
Sure. Why don't you discuss, there's one interesting paradox that I see. In the short run, as real estate investors, and with so much of the materials coming from the emerging markets of the world, we have the benefit of buying goods cheaply now that the US dollar is strong. The flip side of that being, of course, is that if dollars are strong, it's crippling to the emerging market countries when all of their payment settlements and liabilities and all that money we've lent them through the IMF and the various ABCs of government agencies are denominated in dollars. Now that it's crippling their economy. So on the short term, you're going to get some cheaper lumber or some cheaper steel, perhaps. But in the long run, it's going to cream you because you're actually crushing the global economy by crushing the actual people who produce all the real goods and tangible services. So I was hoping you could chime in on that one.
Well, sure. I think maybe we just start from the standpoint of global supply chain, something that I study quite a bit. I've invested in shipping because I see this getting crushed from so many fronts. I mean, we've had a long period of globalization, a long period of free trade, and now that seems to be falling by the wayside. I guess one of the things that we can't really do without, though, as you mentioned, though, would be these natural resources. Of course, America is very strong in energy, but we also burn a lot of energy too. So we're not an exporter. Don't necessarily have an answer to that. We have a large population that's very well spread out. But again, I think we have to take a look at these long-term trends and see what's happening. I mean, I certainly believe that we are going to go back at some point to more global trades, more globalized supply chains. But here, I guess, since we're just lighting this thing on fire, as long as the U.S. Navy rules the seas. A lot of people don't realize just how important it is for America to maintain military dominance. When you talk about whether it's being able to go on vacation or being able to get cheap junk from Amazon, that only exists as long as the seas are ruled. And it's been that way since Britain and later the United States have. So certainly I hope that we continue on that track, and we'll see.
We'll also notice that China has been building a lot more ships than the U.S. I think it's like 3x right now. If you look at a chart, the U.S. has been declining, China's been growing, and now they're building 3 times as many ships as we are, military ships. So that's not great either.
Right, and we know why they're doing that too. And we need Taiwan for the chips they produce and for the message of freedom. China, the first democracy in Asia, and I guess by some respects still going through Taiwan, through the Republic of China.
And what happens if China takes over Taiwan?
Well, we're not having chips for one thing, and the other thing is they're going to have their first island chain, right? They've already got a multi-decade plan to control everything up through the Philippines and beyond. So that would be tremendously bad for the entire world.
Imagine if we outsourced all of our chips to a place like Taiwan. That would be a disaster.
I don't know if I can imagine that ever happening, Chris.
Right.
I'm glad that we're just, we're talking about pretend emergencies here.
Well, This is why we need to build back better, guys. So, I was solving the whole problem. A little dry humor there. We've got about 8 minutes left, so I'm going to make sure I don't ask any more questions. But why don't we open up any questions to the audience that wants to chime in the chat? And then if anyone has any of our panelists have a key takeaway that's burning in their head for our audience that perhaps I missed or something they wanted to clarify, that would be great. I want to make sure nobody has any information or topics that were skipped over.
And the only thing I would say, in my movie Money Game, the elephant in the room is the real economy. We're going to be showing the animals from the savannah, from the big five from the savannah. Nobody talks about the real economy. I believe that the whole system is now completely inefficient in misallocating capital. And just notice that productivity last quarter hit the lowest in 75 years because the whole system is broken in misallocating resources, and it's impacting the real economy, which slows everything. That's one of my big points I made from the movie.
why do you guys think that points like Chris just made? George and I often discuss, probably too much because we're dorks or nerd. He's a nerd, I'm a dork because I'm not PhD. I mean, just the fact that like the lowest labor force participation in 4 decades, no news coverage. Like to Chris's point, record low productivity, no news coverage. Why do you think that is? I find it fascinating that even
Sure.
I guess the mainstream media. I understand. It's not going to
be. Okay, those 2 statements. So how can those 2 statements be like? How can those be true if we're seeing unemployment rates below the natural rate? Which you might think of the natural rate as like the normal rate. There's always going to be some level of unemployment. Natural rate's like 5.5%. We are below that. How are we below that if there's so many help wanted signs? If we're at the lowest labor force participation rate ever, if we're at all of these things that are occurring, how can our unemployment be so low?
Guys like George and I are going to say, look into the math. We use the establishment survey and the household survey, and there's a huge gap that doesn't normally exist between the two, and they're calculated differently. Without getting into it, you'll notice that more people are working multiple jobs, so they double count those people. So that's part of where the Bureau of Labor Statistics, the BLS data. I always call it something I can't say on air, which is, in my opinion, of the BLS data and their usefulness. We'll just do it. But ADP, that's the largest payroll processing company in America, publicly traded company. You would think they might have an idea about employment, right? I mean, they're the largest payroll processor in America. It's a pretty big publicly traded company. They statistically smooth the data. Why do we need the data smoothed? Shouldn't we just get raw data from ADP? Dan, I know you're one of those people, you don't take things on Word. I know you're going to Google it later. Digging a little bit, you'll find that they've just recalculated their methodology. Why do you even need a methodology? Just give us the raw labor data, right?
Yeah. If they don't like the obvious conclusion that the data gives, then that's a great reason to reinterpret it and say, oh, no, it's different. It's different.
Maybe to your point, it's kind of a related thing is, and I'm not sure if it's true, but it's one explanation that I've heard floated out there is the quiet quitting trend. Somebody had asked, how could you have, even if you just believe the numbers, how could you have high employment, higher than what you would say is natural, but have declining GDP? It wouldn't make sense. But it only makes sense if you assume that everything stayed static, that people from home work just as productively as they do in the office. And God, am I going to take a lot of crap for this one? Because if I said this on LinkedIn, I'd get flamed mercilessly by all the people, no offense, justifying what they do, which maybe they're more effective at home. I don't know. I think there's exceptions, of course. I know, Dan, I know you're a big work from home guy, but no offense, I don't think that most people are Dan Freidenberg. And then quiet quitting. If you're working from home and you're logging in and you're half-assing it all day, you're employed, but you're unproductive. So that would be how you could have a relatively high employment rate, but somehow have a low productivity.
Yeah, I saw it in Taipei for sure, because I'd noticed that where I would work, more on the outskirts of the main city, I'd see a lot of people saying like, oh, really desperate for better paying jobs and all that kind of stuff. And then I go to a more posh part of town and they'd be saying it's like, oh yeah, there's just nobody wants to work. And so I'm talking circa like 20, about maybe 19 to 20 years ago is when I'm talking about here. And what it was is in the nice parts of town, people with well-to-do parents are, the ones whose kids are applying for those serving jobs and things like that. And because wage stagnation in Taipei, it was sticking around for about 30 years. And a typical job where you had I'll call it a productive degree involved. So it's not like, like liberal arts to the form of like interpretive dance or something like that. If you're in English or something like that, you'd be making about 12,000 US a year. So about 1,000 a month would be standard. And then if you are a manager or director, you might be able to pull off, like closer to like 1,400 a month. But it hadn't moved, even though housing prices, like doubled and tripled. But of course, they've also got the stronger family ties over there. They don't turn around to their parents and say, it's like, yeah, when I'm 18, I'm out the door, screw you guys. I'm getting my own place and going heavily into debt and not do that. Whereas Asian families are more inclined to say, it's like, no, you're just giving money to other people. Just keep it in the family. So if something goes wrong, we can actually support each other. So there's a lot of wisdom in there, but when you are watching what happened there from a context of like, how can people be tightwads when there's obviously more going on? I think that's the real extent that it goes to. And if people can afford to live off their parents and they realize that whatever wage they're getting, it's not going to contribute to them being able to retire one day. It's not, like if they're waiting for the wages to build up for them to go to work, that seems like a very rational decision for people who can afford to do it, which I've never been one of those people personally. So that's the other force at play, I think, in employment right now, for what that's worth.
Yeah.
So let's move.
We covered in USA Today, but even within economic publications or financial publications, investing publications, these topics are relegated to people like George and I that apparently need to find something better to do with their weekends.
Well, Andrew, do you suppose it's because the news is really just weaving simplified narratives, and that maybe these facts just simply don't fit their narrative?
Agreed.
Well, I like your answer, but it's a little short-winded. It's hoping for a longer answer.
I think one of the reasons is the stock market hit 200% of GDP. So which one of them is the real economy? Is the stock market's bigger than the real economy? So what they're focused on. Notice that everyone in the world is focused on price, right? And I would also argue, why did the quants and the passives win? Because any of us would have looked at that deli in New Jersey when it was $10 million and say, why would I buy a deli in New Jersey that loses $400,000 for $10 million? Then the stock price went from 10 million to 115, and all the 115 million, and all the humans got fired. So I would argue that the stock market is now a policy tool of the Fed. And why do people not talk about it? Because all they're talking about the stock market. Stock market's two times the size of the real economy. It's and by the way, why? Because when interest rates go negative, all assets are worth infinite, and that's what you're seeing. Right? You're seeing a deli in New Jersey trade at $115 million. And it doesn't go much further than that. Because sorry.
Well, no, since I managed to defend almost every political group or economic group, why don't we just defend one more group? We'll go after the crypto hodlers. I've defended everybody. We might as well just defend, make sure we don't miss anybody. Most people, when they think of the crypto boom bust, they're going to say, okay, it's a bubble. It was tulips. It was seashells. It was the 1920 stock market. It was the tech bubble of 2000. We could go on the list of market manias. I would argue, I think, which Chris is going to agree with me on this, is it a reflection of a bubble, or is it a reflection of peak financialization where the new system is credit? I call it creditism. I haven't come up with a better term. Chris calls it financialization. It's the same concept. Is crypto a symptom of a bubble, or is it a symptom of financialization? I think it's a key distinction that isn't being discussed really almost in any discussions that I see on investing.
I would argue that when your currency itself is a Ponzi scheme, they can print money like crazy. You're going to see other Ponzi schemes pop up. Right. So if I had a choice of owning dollars or crypto, I would choose crypto. Because I know, I get it. But if those are my only two choices, I'm just saying if those are, I don't know any cryptos. I'm not saying that, but I'm saying if those are my only two choices, you've got your entire system is a Ponzi scheme because they're printing money like crazy. But during COVID, we increased our money supply by $6 trillion. Money supply back in 2008 was $800 billion, and it rose to $9 trillion in 13, 14 years. Right. So so all you're seeing is so this is my point is when interest rates go negative, everything goes up. The value of my soda here versus my phone, everything goes up the same, and it doesn't matter. It's GameStop and the deli in New Jersey, Amazon, whatever, everything goes up. And so that's what you decide, which gets back to your point about financialization.
By the same token, the Fed talks about their tools, but the only tool we're really seeing is interest rates. All the talk of QT is absolute horse crap. We all know that. You take a look.
It sounds like you're getting off of crypto right here. And the two pieces of the puzzle that I don't think people mention is the anti-nationalism piece of crypto's popularity. And then the other one is evasion of sanctions. So, I'm really super it seemed more than just a coincidence that when Ukraine happened, then Bitcoin kind of took a dump. And that kind of sounds suspiciously like Russia/North Korea cashing out the crypto holdings so that they can actually afford to, have a war or do similar things. I think that's something that's is a factor. I don't know how often that gets brought up, or it's not exactly relevant to commercial real estate, but it is one of the reasons why I stayed away from it personally, even on its way up.
That's a good point, Dan. I mean, yeah, we weren't really we're just using it as a discussion item. We weren't really going to get into crypto too much because
Look at
it's
the
just too much of a
Mhm.
hot button topic.
Right.
Fed's balance sheet. Anybody can do it. You go to Fed.gov, and you can see that the balance sheet isn't going down. That in fact they're buying more mortgage-backed securities. Don't quote me on it, but I want to say they were supposed to be minus 43 billion last month, and they were up $1 billion. They've been talking about thinking about quantitative tightening since June, I believe. I mean, they were supposed to be quantitative tightening in June. We haven't tightened. So I mean, the concept of money supply. We've all read the Chairman Powell quote of "It's time to rethink the money supply." I mean, the money supply is partly what gets us into this mess. Now, I agree with you, Chris, about interest rates, but interest rates alone are not going to solve the problem. To tell the American public we're going to get down to a 2% target anytime soon is absurd when we know there's a 18 to 24-month gap from the time you print the money to when you see the inflationary effects. So I mean, Stephen Hanke is, in my opinion, is the lead economist on the money supply. And his argument is that even if you do nothing, 6% inflation was cooked in the books through 2025, 2026. There's that much money. It takes a long time for it to drain out of the system, let alone we're forgiving student loans and printing money. So if we have 1 minute left. Anybody's got some thoughts on if interest rates actually can succeed in slowing inflation? Dominic, I see you laughing and smirking a little bit.
I'm still shaking my head. I'm like,
I don't think so. I mean, I think because there's too many other variables that are baked in that interest rates just not going to solve. You know what I mean? So again, it goes back to what I said when we first started. Like, the government typically either overshoots or undershoots, and so I think at some point they're just basically going to do whatever ends up happening is going to be, because they kind of hint at it, right? Like what he was saying, was Paul saying that there's going to be pain, in the short term, and it's just a key word, like, hey, there's going to be a real issue going forward, but how long? Again, we just don't know.
I think PPI. So I agree with Dominic. The PPI in Europe, I think, is like 33%. PPI usually leads CPI, producer price index, leads CPI, and I think the interest rates in Europe are 1%. So how do you stop 33% inflation with 1% interest rates? And you're seeing the pain that raising interest rates from 1% to 2%. You're seeing how much that does. So it gets back to it's all talk. Watch their actions, not their words.
Wonderful, guys. Thank you for being such a wonderful panel, everybody. I really appreciate it. Angel, you kept on pace. I know you got to get going to your next presentation.
So how cool was that? I think that was really something.
yeah, that's pretty awesome. I mean, I usually don't like to give any kind of economic thought or idea like out there where it's going to be recorded, because you never know how it's going to turn out, and people hate to be wrong. So it's kind of cool to see that we're still holding pretty tight.
Mm-hmm. Mm-hmm.
Yeah, every pretty much across the board, within reason. Yeah, the world has gone according to what we thought. I mean, obviously, we're not going to predict when interest rates are going to pivot or if they pivot. I mean, you can't predict an unknowable future, but Chris's comments about a sovereign debt crisis are already creeping up in the media, right? Just recently, within the last few weeks. Yeah, companies that are doing layoffs. I mean, it's all coming to fruition. So I would say it aged very, very well.
Mm-hmm. Mm-hmm.
Yeah, the Bank of Japan just further intervened, I want to say 2 days ago, in the currency markets. So yeah, the video aged very well.
Yeah. Well, I mean, it's not terribly old, but the way things are moving now, I believe that it's still going to be very much on target, even the next 3-4 months. 6 months down the road, I think we're going to be fine. I think we made very accurate predictions, honestly.
Yeah, one thing that we didn't cover, and it's not, I mean, it's kind of related to real estate in a sense, but I want to ask you a question. How is it that the Federal Reserve's target is 2%? If a bank account is, let's just say 0.1, we'll just make it 0.2 to make it nice and relatable. You're creating inherently a system of financial repression. It means you cannot win by saving. It forces you to invest. It forces you further and further down the risk curve, unnaturally, artificially, not to what a free market should have, not to what would make common sense. There was a time in America where, you could, a man could, we'll just be politically correct, could have a blue collar job and own a home, and his wife, was a stay-at-home mom. they could save money, buy government bonds, and actually retire. I'm not going to get into conspiracy theories and say it's Wall Street's fault or anything, but all these different special interest groups, not to only pick on Wall Street, the politicians and all the parties, they've established a system very intentionally that makes so you cannot leave money in the bank, just as you were mentioning, right, Angel? You don't want to be collecting 0.1 in a 9%, let's just call it a 9% inflationary world. Every time you go to the grocery store, you're buying less, less eggs or less milk or less diapers or whatever the heck it is, you're buying, hopefully not expensive perfumes. The idea inherently that, like, how does that not get financial press? Like, how did they come up with, like you're saying, well, what's so special about 2? Why is it not 1.5? Why is it not 2.5? Why are they already talking about a new normal of 4%, 5%, 6% is acceptable inflation? Why isn't inflation even acceptable? Dan's thinking in an ideal utopian world, if we're all going to be namby-pambies and we're going to drink Kool-Aid and eat granola and play, what is that, the koosh ball thing? You little liberals like to play the picking around the little ball.
You mean hacky sack or?
Yeah, hacky sack. Yeah, if we're all going to play hacky sack and eat granola and drink Kool-Aid, and I'm going to wear a tie-dyed shirt and sing Kumbaya, and we'll have a group hug later. Shouldn't we be deflating prices? If that's our socialist utopian world, prices would either be highly stable or would be declining. Everything should be like a TV. Things shouldn't be going up. Then in your utopian idealistic world, if you're going to be a benevolent totalitarian government, shouldn't prices be stable or going down? I mean, last I checked, the Fed's charter is 2 things. It's reasonable full employment and price stability. 2% inflation isn't really price stability in my mind. Now, they're going to argue that you need instability for growth, so it's acceptable levels of instability. But if it's acceptable level instability, why are how on earth are savings rates so low in the United States? Why do you get so little on a checking account or a savings account? How does that work?
Well, it seems like a symptom, though, because the one that I've been thinking about a whole bunch is, the 1% gets blamed for everything, even though it's the 0.01% that actually has any real sway. But the issue that I think really comes up is when that wealth doesn't usually make it to the 3rd generation, then that means there's a force that's picking away at everybody's wealth. You have to be doing something exceptional, or else whatever you have is going to be whittled away. And there is an intentionality about it. Sure, they're doing that 2% inflation just so that when they have to pay a bill, they're using cheaper dollars to pay it than today, and you always have to pay for tomorrow today when you're in government, assuming that you're actually doing anything positive whatsoever, right? The idea being, if the highways aren't ready for an extra 100,000 people by the time 100,000 people are living in the city, then it's already too late. That's what I mean by paying for tomorrow today sort of thing. And again, that's very kumbaya. But as far as I'm concerned, at the top, I don't see any indication that any political party is actually serious about helping people who are having trouble. It seems like they're only helping the people at the top. And sure, it's nice to say, okay, commercial real estate syndicators, that puts you way up there. But it's like, I hate to break it to you, not even close. It's so much farther beyond us than.
Dan, what is the term for that? The term. I believe it's from the 1700s. That's the Cantillon effect.
The what effect? Sorry.
The Cantillon effect.
Oh, okay. Yeah, I didn't hear that one.
Basically, the concept is those closest to the money disproportionately benefit from its trickle. When we talk about trickle down economics and why it's doesn't work, it's because the lobbyist gets a disproportional share. The politically connected guy that runs the website that gets a no-bid contract from a government, they get the money. so the workers get nickels and dimes on their wage increase, but the contractor took the share of the money. The political corruption, it's a funny thing I always find. I mean, if you're going to say capitalism sucks, that's fine, if you don't like capitalism. But what Chris and I are both going to argue is you're not really seeing capitalism, one. Right. And two, even if you said this is capitalism, is it crony capitalism? And you're going to say, well, a lot of the symptoms that you say, I hate capitalism because of X. I'm going to say, no, you hate corruption or you hate cronyism. But let's be honest, since the dawn of time, whatever the system was, whether it was a tribe, a chief, a king, socialism, communism, capital, whatever you want to call it, there's always been human corruption. So if you're against corruption, that's great, but don't conflate corruption and capitalism. That's one of the arguments that that I think a distinction that a lot of investors are going to miss. And clearly, I mean, look at the way the United States works or the way Canada works, for instance. I mean, Justin Trudeau isn't exactly missing any meals, right? I mean, I look at the suits that our politicians wear, and most of these suits would finance the average American's rent for a month. How many suits does Justin Trudeau have in his closet? I'm going to guess more than 12. So if the gentleman's closet can house a family for a year, there's a problem with the system. How would you call yourself a public servant? You're in a service position, yet you enter politics and leave wealthier. And someone say, "Well, Andy, that's capitalism." Well, I'm going to say, no. Go around most of the world, except maybe the Nordic countries. There's some exceptions, but generally speaking, Vladimir Putin, kind of richer once he became in charge. Xi Jinping, kind of richer once he got in charge. Justin Trudeau, who's a second generation nepotism candidate, right? Isn't his father Pierre Trudeau? The family rather enriched themselves. And United States of America, Nancy Pelosi, several of these people, they enter office at one stage, the Clintons, they get wealthier when they leave. It's an odd effect. But again, capitalism evil. That's why real estate prices are so unreasonable in America. Okay, then why is Shanghai more unaffordable? That's not capitalism, most people would say. Why is Melbourne's prices crazy compared to America's? Why is Toronto, Vancouver more unaffordable and just insanely priced? Why would Sydney, Berlin, Brussels, which is the home of the EU, have prices that make our prices look affordable in comparison? If capitalism is the source of real estate prices.
Yep. It just doesn't add up. And the book I've been reading recently is The Aristocracy of Talent by Adrian Wooldridge. And one of the big takeaways I've enjoyed was how they were talking about how people used to get positions in a monarch style of government. And it was basically begging the monarch for a bunch of BS. The less they had to do, the better. But, it's just literally like, I think it said Louis the 14th, like from the moment he woke up and moved a leg to the side of his bed, he was already getting hit up for jobs. And so that's apparently the origin of government. And so if you think from a physics perspective in terms of momentum, which means that heavy things are slow to speed up and they're even slower to slow down, I think that is what a lot of is being paid for in government in general. And then the other issue is that, like, why do people pay so much? Why is it that people in Canada pay the same amount of tax as people in, say, New York? But, when I had a collapsed lung, I went to the hospital and I was all fixed up. I just left. I didn't have to go to a cashier's table or anything. It's included. I had to show them, proof that I'm Canadian. But like, where's all that money going? And that's pretty clear. But I think the important thing to realize is just the nature of government itself. And the Pareto principle is the one that comes up to my mind most strongly. You've got so many people who do not value productivity in any way, and that's across the entire economy. And I think that has a lot to do with these layoffs. And part of that is because of my programming experience and just realizing how many jobs can be automated if you've got clever enough programmers. But that's my retort anyway.
Yeah, but one of the during good times, what is your natural incentive if you're Angel Williams and you work for a corporation, not Angel Williams, the entrepreneur. So you work for Wichita Falls spring making company.
Mhm.
You're gonna increase your fiefdom. What is the benefit? What is Angel's best benefit? Angel's best benefit is to have as many people under her supervision so she increases her clout, so she can say to another employer, I manage 20 people, you should hire me. Or she goes to her company and says, I manage 20 people now, it used to be 10, pay me more. Whether or not she really needed those additional 10 people, or she should have hired Dan Friedenberg to make an app that would make things more efficient. The disconnect between human incentives and the economy, I always find very interesting. I mean, like for the government, we create new committees. We keep creating new departments. How many departments do we really need? We have FBIs and ATFs and Secret Services.
NSA.
And we got NSAs and we got Homeland Securities, and I mean we got local sheriffs and state police officers, and I mean I'm not in no way am I picking on law enforcement. It's just an easy example. I mean, our answer to everything is to create a new department, but it goes back to the human incentive. I don't want to maintain what Dan Friedenberg, the politician, created 5 years ago. I want to make my stamp. So I want, the Rosenberg Act, and I want to create, a Department of Misinformation, because, the greatest threat facing America is anybody thinking for themselves. Because, that would be dangerous, right? So we're going to have to fund it, and we're going to need buildings now, and we need a budget. And now I've created something, and wow, lo and behold, because of all this money we spent, there's all these special interest groups and lobbyists that now owe me favors so I can do book deals, speaking engagements. My son can get a job there. The charities that are started up, all of a sudden my relatives are on these charities. I mean, it's a big shock, right, to everybody here. I mean, that's why it's hard to believe that once the beast gets rolling, like you're saying, Dan, once that boulder rolls down the hill, trying to stop it is just, it's like, it's a snowball effect. There's an interesting book that it's hard to find, but it's called Gallipoli in the 39th Day. And Dan would enjoy it just because it's very heavily statistically oriented. And the thesis of the book is that there's no point in trying to stop the beast. The beast has just got the momentum. But they make the analogy of duckweed. Duckweed being like an algae that covers a pond. And it doesn't grow in a linear fashion. It grows exponentially. So I think it's the 40th day, Dan, the whole pond is covered in duckweed and everything dies, all life. The 39th day is that last day before the exponential doubling of growth before the whole pond dies. And that's actually their analogy of the American empire. So much like Rome or other empires that came and went, that the government portion of GDP, the government portion of control in the media and all these different factors, it goes to a point where it basically kills itself and you go into regression. A guy like you would enjoy the book. I'm actually supposed to ship it off to my copy to Douglas Dowell.
There you go. We can share it.
It's an expensive book because it's not much in print. So instead of telling Douglas to spend $120 to find the book, I told him I'd ship him my copy and lend it to him. Douglas, if you're listening to this, I want the book back. I'm kicking your ass.
Don't make them swim from Hawaii.
Yeah, all 5'5" of me, is going to try to beat up Douglas Dowell, which he looks like a rather large guy. So I might have to bring a bat, but I'll do what I got to do.
And on that note, speaking of I'll be back, we will be back next Friday at 11 a.m. Eastern for the REI Rocks review. I got to thank Angel for putting on all of these different summits, getting all this amazing stuff. This is really cool to have something where every week we can hop on, share some time with these lovely people and talk about what goes through commercial real estate, syndicators, investors, buyers, sellers, all that kind of stuff. What goes through our heads as far as how do we predict our next move? So
Absolutely.
that's all that I got for today. Angel, you want to sign off for everybody?
Yeah, no, I would just, just a takeaway, just things are crazy, and I don't know that it makes sense. I don't know that it'll ever make sense. So if you're confused about what's going on, you can hop on board with the rest of us, because I think we're all confused.
Yep. And the meetup, the Marvelous Mondays meetup is probably the best way to do that. The link is now on the screen right there, and noon Eastern every Monday, even on Christmas, which I don't know. That doesn't
Isn't
matter.
going to happen for a few years. We'll revisit.
Good stuff. Good stuff. So thank you very much for watching today. Andrew, thank you for joining. This is a fantastic
having me,
panel and
guys.
awesome conversation. Cool.
Bye, guys.
Bye.